In 2008, the global economy collapsed almost overnight. Trillions vanished, banks failed, entire industries froze. In the 1930s, it was worse. 1 in 4 workers jobless, markets in freefall, panic in the streets. Now, the signs are flashing again. Global debt is at an all-time high. Inflation is rising, political systems are fraying. Every boom in history ends the same way, with a crash. The only question now is, how far down does this one go? The Great Depression of 1929 serves as the perfect cautionary tale. The stock market crash that year triggered a global economic collapse that led to 25% unemployment in the US and a staggering 30% contraction in GDP. Over 9,000 banks failed between 1930 and 1933. The ripple effects were felt worldwide, causing pain that lasted for years. Major economies struggled, and even some household name companies went under or were forced to drastically restructure. For example, in the US, the government had to intervene to save critical companies, but for many, the damage was already done. Fast forward to the 1970s, when the oil crisis took the world by surprise. The Yom Kippur War and OPEC's oil embargo pushed oil prices up by a staggering 400%. This created immediate global economic upheaval, leading to high inflation and unemployment, what we now refer to as stagflation, a deadly combination of rising prices and stagnant economic growth. Inflation surged to 11% in the US, and unemployment hit 8%. As economies around the world adjusted, countries like Greece and Italy faced prolonged financial instability, leading to debt crises that took years to resolve. Then we come to the 2008 financial crisis, where the collapse of Lehman Brothers became the tipping point that sent shockwaves across the globe. The stock market lost trillions of dollars in value, and millions of people lost their jobs. The US unemployment rate hit 10%, while global GDP shrank by 0.1%. Governments around the world were forced to bail out failing institutions, pouring over $10 trillion in stimulus and recovery funds into the system. The US government also intervened to save corporations like General Motors, which had to file for bankruptcy and restructure under government support, becoming one of the most prominent examples of corporate failure and recovery. Similarly, Greece was hit hard by the crisis, suffering a massive debt crisis that required 3 major international bailouts. By 2010, Greece's public debt had surged to around 146% of GDP, a figure that was unsustainable. Unemployment skyrocketed to 27.5% by 2013, and youth unemployment reached a staggering 60%. The government was forced to implement harsh austerity measures as part of the bailout agreements, including tax hikes, pension cuts, and salary reductions for public workers. By 2017, the Greek economy was still 25% smaller than it was before the crisis, and the country had been under austerity measures for almost a decade. Greece's GDP growth didn't return to positive territory until 2018, showing the long-term scars of the crisis. While the bailout packages provided some relief, they also saddled Greece with long-term debt and led to widespread social and political instability. Many economies, especially in Europe, have never fully recovered from the burden of debt, and the effects on the global financial system still linger. The first warning sign we need to pay attention to is debt. And it's not just a problem for governments, it's a problem for everyone. The US national debt alone has now surpassed $31 trillion, and that's about 125% of GDP. To put it in perspective, that's more debt than the entire US economy produces in a year. This is the highest debt to GDP ratio in history, surpassing even the levels we saw during World War II. Here's the kicker: $800 billion of that debt is just in interest payments alone. That's money that could be spent on healthcare, education, infrastructure, or other critical areas. But instead, it's just going to pay off a growing debt that's becoming more and more unsustainable. And it's not just the government. Corporate debt has also skyrocketed. In the US, total corporate debt has surpassed $10 trillion. Many companies are running up debt, borrowing at historically low interest rates, and using that borrowed money to fund growth. But as interest rates rise, those companies will find it harder to pay off their loans, and that could lead to widespread defaults. In fact, we're already seeing this. The Federal Reserve has raised interest rates to 5.5% as of 2025, the highest level in 15 years. This is part of their strategy to control inflation, But it comes with risks. The more they raise rates, the more expensive it becomes to borrow money, both for consumers and corporations. What happens when borrowing costs are too high and debt starts to pile up? We could see a wave of defaults on everything from mortgages to corporate loans to government bonds. The next thing we need to consider is how interconnected the world economy is. A problem in one region can quickly spread to others. A perfect example of this is the trade war between the US and China. Between 2018 and 2020, tariffs and trade barriers led to a reduction in global GDP growth by 0.5% annually, according to the World Bank. Those trade tensions disrupted supply chains, raised costs for consumers, and created instability in the markets. Then, of course, there's the COVID-19 pandemic. Global trade contracted by 5.3% in 2020, the worst drop since World War II. Nearly every industry, from automotive to electronics, felt the impact of broken supply chains, shortages, and delayed production. On top of all this, geopolitical tensions like the war in Ukraine are pushing energy prices through the roof. In 2022, oil prices surged by 50%, and natural gas prices jumped by more than 200%. This has caused inflation to spike, particularly in Europe, where skyrocketing energy bills are crushing consumers and businesses alike. The world is more interconnected than ever, and economic issues in one region can quickly become a global crisis. Another major factor to consider is technological disruption. While technology has driven massive productivity gains, it's also creating widespread job losses. The rise of automation and artificial intelligence has led to the displacement of millions of workers. In fact, the World Economic Forum predicts that by the end of 2025, 85 million jobs could be displaced by automation and AI worldwide. But it's not just factory workers who are at risk. AI and automation are impacting white-collar jobs too, like those in customer service, data analysis, and even healthcare. This shift in the labor market is creating an increasing divide between the rich and the poor. Meanwhile, the gig economy is growing. Over 30% of the US workforce now relies on platforms like Uber and Instacart for income. While these jobs offer flexibility, they come with lower wages, no benefits, and no job security. It's leading to higher economic inequality, with the richest 1% of people now owning 44% of the world's wealth, while the bottom 50% hold just 1%. This growing wealth gap is only increasing, and it's likely to lead to more social and economic instability. Governments and central banks play a critical role in managing the economy. Since the 2008 financial crisis, the US Federal Reserve and other central banks have been using low interest rates and quantitative easing to boost the economy. But these actions have come with unintended consequences. The Fed's balance sheet, for example, grew from $900 billion in 2008 to over $7 trillion by 2020. By flooding the economy with money, they helped stave off collapse, but they also inflated asset bubbles in stocks, real estate, and corporate bonds. Now, as the Fed raises interest rates to combat inflation, these bubbles could burst, causing a domino effect in the markets. At the same time, governments worldwide have been taking on massive debt to finance pandemic relief. The European Union, for example, created a €750 billion recovery fund to help stabilize its economy after COVID-19. But as inflation continues to rise and interest rates climb, many countries will struggle to meet their debt obligations, leading to potential defaults or austerity measures that could exacerbate the crisis. Inflation is a growing concern. In 2022, global inflation surged to 9.2%, the highest it's been in over 40 years. In the US, the Consumer Price Index, CPI, peaked at 8.5%. This is affecting people's purchasing power, especially when it comes to essentials like food, gas, and housing. To tackle inflation, the Federal Reserve has been aggressively raising interest rates. Since 2022, they've raised the rates by more than 4.5%, pushing borrowing costs higher. While this is necessary to control inflation, it also risks pushing the economy into recession. Higher rates mean higher mortgage payments, higher loan costs, and slower economic growth. The warning signs are unmistakable. Rising debt, technological disruption, global interconnectedness, inflation, and tightening monetary policies all point toward a potential economic storm. The next crisis may not look like the last one, but the risks are real. The next few years will determine whether we collapse under the weight of our own financial system. Will we learn from history, or will we repeat it?